Welcome back to The Art of Progress. Today we're exploring one of the most iconic books in the world of investing, The Intelligent Investor by Benjamin Graham. This book, first published in 1949, is considered the Bible of value investing. It has influenced countless investors, including Warren Buffett, who calls it by far the best book on investing ever written. In this video, we'll break down the key concepts and strategies that Graham shares so you can apply them to your own investing journey. Let's get started. Chapter 1: Investment versus Speculation. In this chapter, Graham draws a clear line between investing and speculation. He defines investing as an operation that, after thorough analysis, promises safety of principal and an adequate return. Speculation, on the other hand, is any operation that does not meet those criteria. Graham warns that many people engage in speculative activities under the guise of investing, often leading to unnecessary risks. He emphasizes that an intelligent investor must be disciplined and prioritize the protection of capital. Zweig's commentary. Zweig expands on Graham's ideas, noting that the line between investing and speculation has blurred even more in modern markets. He discusses how easy access to trading platforms and the influence of media can lead investors to speculate without realizing it. Zweig advises modern investors to maintain a clear focus on long-term goals and to avoid the temptation of quick profits. Chapter 2: The Investor and Inflation. Graham discusses the impact of inflation on investments, particularly on fixed income securities like bonds. He argues that inflation can erode the real value of returns, making it essential for investors to consider inflation when constructing their portfolios. Graham suggests that stocks, due to their potential for capital appreciation, may provide a better hedge against inflation compared to bonds. Zweig's commentary. Zweig provides context by explaining how inflation has behaved in different economic periods. He highlights the importance of diversifying across asset classes to protect against inflationary pressures. Zweig also discusses modern tools like TIPS, or Treasury inflation-protected securities, that investors can use to guard against inflation. Chapter 3: A Century of Stock Market History. The level of stock prices in early 1972. Graham offers a historical overview of the stock market, highlighting its cyclical nature. He explains how the market has experienced periods of significant booms and busts, argues that understanding this history is crucial for making informed investment decisions. Graham uses this historical perspective to demonstrate the importance of maintaining a long-term view and not being swayed by short-term market movements. Zweig updates this discussion by including more recent market events, such as the dot-com bubble and its aftermath. He stresses that while market conditions change, the underlying principles of cycles remain the same. Zweig urges investors to learn from history and be cautious during periods of irrational exuberance. Chapter 4: General Portfolio Policy. The Defensive Investor. Graham introduces the concept of the defensive investor, someone who prioritizes safety and a hands-off approach to managing their portfolio. He recommends that defensive investors maintain a balanced portfolio of high-quality bonds and blue-chip stocks with a suggested allocation of 50% stocks and 50% bonds. The goal is to preserve capital while achieving modest returns. Zweig discusses how modern defensive investors might approach asset allocation, suggesting the use of low-cost index funds and ETFs for diversification. He also emphasizes the importance of regularly rebalancing the portfolio to maintain the desired asset allocation, especially in volatile markets. Chapter 5: The Defensive Investor and Common Stocks. Graham offers guidance on stock selection for the defensive investor. He advises focusing on large, conservatively financed companies with a long history of dividends. Graham stresses that defensive investors should be cautious about overpaying for stocks and should seek out companies with strong financials and stable earnings. Zweig warns against value traps, where stocks appear cheap based on traditional metrics but are actually facing significant challenges. He advises using a variety of financial metrics and considering the broader economic context when selecting stocks. Zweig also suggests using online tools to screen for stocks that meet Graham's criteria. Chapter 6: Portfolio Policy for the Enterprising Investor. Negative Approach Summary. Graham discusses the enterprising investor, someone willing to take on more risk and actively manage their portfolio. He outlines a negative approach, advising enterprising investors to avoid certain types of investments, such as new issues and high-growth stocks that are often overpriced. Graham emphasizes the importance of thorough research and analysis. Zwig elaborates on Graham's warnings by discussing modern examples of speculative investments that often fail to deliver long-term value. He stresses the importance of sticking to areas where the investor has expertise and avoiding the temptation to chase high-risk, high-reward opportunities without adequate research. Chapter 7, Portfolio Policy for the Enterprising Investor, the Positive Side Summary. This chapter explores the positive approach for the enterprising investor, focusing on opportunities to achieve higher returns through more active management. Graham suggests strategies such as investing in undervalued stocks, purchasing stocks in companies undergoing special situations like mergers, and investing in well-established but temporarily out-of-favor companies. Zwig discusses how modern investors can apply these strategies, highlighting the importance of patience and discipline. He also addresses the psychological challenges of being an enterprising investor, such as the need to withstand short-term volatility in pursuit of long-term gains. Chapter 8, The Investor and Market Fluctuations. Graham introduces the concept of Mr. Market, a metaphor for the stock market's daily fluctuations. He advises investors to take advantage of Mr. Market's irrational behavior by buying when prices are low and selling when they are high. Graham emphasizes the importance of staying calm during market volatility and not letting emotions dictate investment decisions. Zwig emphasizes that the concept of Mr. Market is even more relevant in today's hyper-connected world, where news cycles and social media can amplify market swings. He advises investors to focus on the intrinsic value of their investments and to use tools like dollar-cost averaging to mitigate the effects of volatility. Chapter 9, Investing in Investment Funds. Graham examines the pros and cons of investing in investment funds, such as mutual funds. He advises investors to choose funds with low fees, conservative management, and a strong track record. Graham also warns against funds that engage in excessive trading or speculative strategies. Zwig discusses the rise of index funds and ETFs, which offers a low-cost diversified option for investors. He emphasizes the importance of keeping expenses low and avoiding the temptation to chase past performance. Zwig also discusses the benefits of automatic investment plans that allow investors to build wealth consistently over time. Chapter 10, The Investor and His Advisors. Graham offers advice on how to choose and work with financial advisors. He stresses the importance of finding an advisor who is both competent and trustworthy. Graham warns against advisors who push speculative investments or charge excessive fees, advising investors to seek out professionals who align with their own conservative investment philosophy. Zwig expands on Graham's advice, discussing the modern landscape of financial advisors, including the rise of robo-advisors and fee-only planners. He emphasizes the importance of transparency in fees and services and advises investors to be cautious of conflicts of interest. Chapter 11, Security Analysis for the Lay Investor. General Approach Summary. Graham introduces the basics of security analysis for non-professional investors. He explains the importance of analyzing a company's financial statements, including its income statement, balance sheet, and cash flow statement. Graham also discusses the importance of understanding the company's industry and competitive position. Zwig provides practical tips for modern investors, such as using online resources to access financial data and analysis tools. He also emphasizes the importance of focusing on long-term trends rather than short-term fluctuations in a company's performance. Chapter 12, Things to Consider About Per-Share Earnings. In this chapter, Graham discusses the potential pitfalls of relying too heavily on per-share earnings when evaluating a company. He warns that earnings can be manipulated through accounting practices and that investors should look beyond the headline numbers to understand the true health of a business. Zwig highlights the importance of considering other metrics such as cash flow and return on equity, in addition to earnings per share. He also discusses the risks of focusing too much on quarterly earnings, which can lead to short-term thinking. Chapter 13, A Comparison of 4 Listed Companies. Graham provides a detailed comparison of 4 companies to illustrate his approach to security analysis. He examines each company's financial statements, competitive position, and management quality, demonstrating how to apply the principles of value investing in practice. Zwig updates Graham's analysis by discussing how investors can conduct similar comparisons using modern tools and resources. He also emphasizes the importance of looking for companies with sustainable competitive advantages and strong management teams. Chapter 14: Stock Selection for the Defensive Investor. Graham outlines criteria for stock selection tailored to the defensive investor. He advises focusing on large, conservatively financed companies with a long history of dividend payments. Graham also suggests using financial metrics such as the price-to-earnings ratio to ensure that stocks are purchased at reasonable prices. Zwig discusses how defensive investors can use modern screening tools to identify stocks that meet Graham's criteria. He also emphasizes the importance of diversification to reduce risk and protect against unforeseen events. Chapter 15: Stock Selection for the Enterprising Investor. Graham provides guidelines for the enterprising investor who is willing to conduct more in-depth research to achieve higher returns. He suggests looking for companies that are temporarily out of favor, have strong balance sheets, or are involved in special situations like mergers or restructurings. Zwig highlights the challenges of being an enterprising investor in today's market, where information is readily available and competition is fierce. He advises focusing on areas where the investor has a genuine edge, such as specialized knowledge or experience in a particular industry. Chapter 16: Convertible Issues and Warrants. Graham discusses the potential benefits and risks of investing in convertible securities and warrants. He explains how these instruments can offer the upside potential of stocks with the downside protection of bonds, but warns that they can also be complex and speculative. Zwig updates this discussion by explaining how convertible securities and warrants are used in today's market. He advises caution when investing in these instruments, especially for defensive investors, due to their complexity and potential risks. Chapter 17: 4 Extremely Instructive Case Histories. Graham presents 4 case studies to illustrate the principles of value investing. He analyzes the financials, management, and market conditions for each company, showing how a disciplined, value-oriented approach can lead to successful investment outcomes. Zwig provides modern examples to complement Graham's case studies, demonstrating how the principles of value investing apply in today's market. He also emphasizes the importance of learning from both successful and unsuccessful investments. Chapter 18: A Comparison of 8 Pairs of Companies. Graham compares 8 pairs of companies, one in each pair being a more speculative investment, and the other being more conservatively managed. He uses these comparisons to highlight the importance of focusing on solid, well-managed companies rather than chasing speculative opportunities. Zwig updates this analysis by discussing modern companies that fit Graham's criteria. He stresses the importance of avoiding speculative investments, especially in markets driven by hype and short-term trends. Chapter 19: Shareholders and Management's Dividend Policy Summary. Graham discusses the relationship between shareholders and management and the importance of dividend policy. He argues that companies with strong earnings should return capital to shareholders through dividends, rather than holding cash or reinvesting in marginal projects. Zwig discusses how dividend policy has evolved in modern times, with more companies opting for share buybacks instead of dividends. He advises investors to consider a company's overall capital allocation strategy, including dividends, buybacks, and reinvestments, when evaluating its potential. Chapter 20: Margin of Safety, as the central concept of investment summary. Graham concludes with the principle of the margin of safety, which he considers the most important concept in investing. He advises investors to always buy securities at a significant amount to their intrinsic value to protect against errors and market volatility. Zwig reinforces the importance of the margin of safety, arguing that it remains the cornerstone of a sound investment strategy. He advises modern investors to apply this principle consistently, especially in an era of heightened market volatility and uncertainty. The book concludes with several appendices, including examples of historical documents and an analysis of the performance of defensive and enterprising portfolios over time. These appendices provide additional context and reinforce the lessons learned throughout the book. Zwig's commentary off the appendices offers modern perspectives on the data presented, providing further insights into how Graham's principles have stood the test of time. So what can we learn from The Intelligent Investor? Benjamin Graham teaches us that successful investing is about being rational, disciplined, and patient. It's about distinguishing between investment and speculation, understanding the intrinsic value of your investments, and always leaving a margin of safety. It's about diversifying your portfolio, managing your emotions, and keeping a long-term perspective. By following these principles, you can develop an investment strategy that's not only smart, but also resilient. one that can help you achieve your financial goals regardless of what the market throws your way. What do you think about Benjamin Graham's approach to investing? Do you apply any of his principles in your own strategy? Share your thoughts in the comments below. And if you found this video helpful, don't forget to give it a thumbs up and subscribe to the channel for more insights on investing and financial wisdom. Thank you for watching, and until next time, happy investing.